Health insurance policies have other provisions that define their features, benefits, and limitations. Free look, right to examine. The free look provision, or the right to examine provision, lets policy owners return the policy to the insurer within a certain time and receive a full refund of all premiums and fees paid. Health insurance policies normally allow the policy owner a 10-day free look period. Depending on the type of coverage and the policy owner's age and state of residence, that period can be 20 or 30 days. The period begins when the policy is delivered to the policy owner. Key point: the policy owner can return the policy during the free look period for any reason, or no reason at all. As long as the policy owner returns the policy to the insurer within this period, the insurer must refund the premium and any fees that the policy owner paid. Insuring clause. The insuring clause is the insurer's promise to pay a benefit if a certain event occurs. The insuring clause describes the type and scope of coverage, defines terms used in the policy, states the conditions under which the policy will pay a benefit. Consideration clause. A health insurance policy is a contract. It requires an offer, acceptance, and consideration. The consideration clause states the consideration that the parties exchange. The applicant's consideration is the application and the first premium payment. The insurance company's consideration is the promise to pay a benefit for a covered loss. Probationary period. Individual and group health insurance policies can have a probationary period. In an individual policy, a probationary period is the time that must pass between the policy's effective date and the time when losses are covered. It helps the insurer avoid adverse selection. So, probationary periods usually exclude coverage of losses related to illness. Accident-related losses, however, are unforeseen and do not invite adverse selection. Therefore, accidents are covered as soon as the policy is issued. Example: Mike has a disability income policy with a 10-day probationary period. He suffers a disability from an illness 5 days after buying the policy. Any losses from this disability are not covered. Susan also has a disability income policy with a 10-day probationary period. 2 days after she buys the policy, she accidentally falls, resulting in a disability. Her losses are covered immediately. In group insurance, the probationary period is the time the employee must be employed before being eligible for insurance benefits. The employer sets the period. Elimination period. An elimination period is the period after a loss before benefits begin. Elimination periods usually appear in disability insurance and long-term care insurance policies. Like deductibles, they reduce or avoid small claims. Example: 6 months ago, Ben bought a disability income policy with a 45-day elimination period. He suffers a disability on June 1st. His benefits begin on July 15th. Key point: do not confuse the elimination period with the probationary period. A probationary period lasts only for a specific time after a policy is issued. An elimination period begins every time a covered loss occurs. Waiver of premium. A waiver of premium provision states that the insurer will waive the premium if the insured is disabled. The insurance remains in force. Common policy exclusions. Policy exclusions are conditions that are not covered. The insurer denies claims related to these conditions. Health insurance policies usually do not cover self-inflicted injuries, illness or injury from war and military actions, sickness or injury while on active duty in the armed forces, cosmetic surgery, infertility treatments, non-commercial airline travel, injuries or sickness covered by workers' compensation, treatment in a government hospital, losses incurred while committing a felony. Pre-existing conditions. A pre-existing condition is a health condition that existed before an insurance policy was issued. A pre-existing condition is a sickness or physical condition for which medical advice or treatment was recommended by or received from a physician, or symptoms existed that would cause a careful person to seek diagnosis, care, or treatment. A pre-existing condition exclusion denies coverage for loss related to the pre-existing condition if the loss arose within a certain time, usually 12 to 24 months, after policy issue. Pre-existing condition exclusions were once common in health insurance policies to help insurers control costs. They are no longer used except in limited circumstances. They still appear in disability income and long-term care insurance policies. The Patient Protection and Affordable Care Act, PPACA, or ACA, ended the use of pre-existing condition exclusions in medical expense insurance. Since 2014, medical expense insurers cannot deny coverage or charge a higher premium because of a pre-existing condition. There is an exception for plans that have grandfather status. These plans took effect before March 23, 2010, and have remained substantially unchanged since. Insurers cannot deny or cancel coverage for children because of a pre-existing condition. Provisions for renewability. Health insurance policies cover a specified period of time, typically 1 year. Coverage may be renewed. A policy's renewability provision allows the insurer to increase premiums or cancel coverage. It also states the policy owner's right to renew coverage. Renewal provisions can make a policy non-cancelable, guaranteed renewable, conditionally renewable, optionally renewable, cancelable, non-cancelable. The insurer of a non-cancelable health insurance policy cannot cancel the policy or increase the premium. Non-cancelable policies present the greatest risk to the insurer, so this renewal provision is more expensive than others. Non-cancelable provisions are common in disability income policies issued to those in low-risk white-collar and professional occupations. Most policies limit the policy's non-cancelability to age 65, or full retirement age. Non-cancelable provisions are rare in medical expense policies. Guaranteed renewable. A guaranteed renewable policy assures the policy owner that the insurer will not cancel the policy, although it may increase premiums. If the insurer increases premiums, it must raise them for all policies in that class issued in the state. A guaranteed renewable provision is standard in medical expense insurance policies and long-term care policies. It is also standard on most disability income policies. Those issued to the lowest risk policy owners typically include the non-cancelable provision. A policy is usually guaranteed renewable only until the insured reaches age 65. Conditionally renewable. In a conditionally renewable health insurance policy guarantees that the policy owner can renew coverage. However, the policy owner must meet certain conditions. These conditions must be related to the insured reaching a certain age or losing employment or membership in an association that provides the health coverage. These conditions cannot be associated with the insured's health. With a conditionally renewable policy, the insurer cannot cancel coverage if the insured meets the conditions necessary for renewal. However, the insurer can increase premiums. Optionally renewable. The optionally renewable provision gives the insurer the right to cancel the policy on a certain date. It also lets the insurer increase the premium for those in the optionally renewable class. Policies are subject to cancellation or premium increases on their anniversary date. Cancelable. A cancelable policy lets the insurer cancel the policy at any time by giving written notice. The insurer must refund any advance premiums paid before canceling the policy. Cancelable policies also allow for premium increases. A type of cancelable, non-renewable policy is the term health policy. This type of health insurance covers only limited periods, such as 6 months. People often buy term health policies for periods between life events. For instance, this policy can be useful after a young person graduates from college and before he or she becomes employed, at which point, he or she may be covered by an employer's group health plan. Once a term health policy has ended, an insured who wants a new policy must reapply. There is no guarantee that the policy will be issued. Prohibited policy provisions. Most states do not allow insurers from including a contract provision that limits the period for filing a lawsuit against the insurance company to less than 1 year after a loss. Makes a producer's acts or representations binding on the insured. Makes the producer also the insured. Additional health insurance provisions and riders. Several provisions tailor a policy to the insured's needs. Automatic increase option. The automatic increase option increases benefits by a specified amount to keep pace with inflation. This is like the cost of living adjustment rider in disability income and long-term care policies. Benefits may increase as often as every year. Benefit integration. Some health policies integrate the benefits they pay with similar benefits the insured gets from other sources. This is common with disability income policies, which often specify the total benefit amount, from all sources, that the insured may receive. This amount is less than 100% of the insured's gross income and prevents overinsurance. Example: Bob's disability income policy integrates benefits. The policy limits the total benefit he can receive from all sources to 75% of his gross income. Bob's gross monthly income is $6,000. His policy will pay the maximum $4,500 per month if he qualifies for benefits but receives no other form of disability benefit. If Bob becomes totally disabled and qualifies for Social Security disability benefits of $1,500 per month, his policy will pay the difference, $3,000 per month. The possibility that Bob's benefit would be reduced by Social Security was factored into the premium rate charged to him. This kept the rate lower than it would have been had the benefit been a flat $4,500 per month regardless of other benefits. Beneficiary benefits. Accidental death and dismemberment, AD&D, insurance requires a beneficiary designation. If the insured dies in an accident, the beneficiary gets the benefits. Some forms of medical expense insurance also require a beneficiary designation. If the insured dies before the claim is paid, the beneficiary gets the payments that would otherwise be paid to the insured. Transplant coverage. Medical expense policies often cover all or a portion of the cost of organ transplants. Coverage may be provided through a standard policy provision or as a rider added to the policy. The following table summarizes the other common standard provisions in health policies. Please pause the audio and review the table. For review. The free look period begins when the policy is delivered to the policy owner. The applicant's consideration in the health insurance contract is the application and the first premium payment. Probationary periods exclude coverage only of illness-related losses. Accident-related losses are covered as soon as the policy is issued. The probationary period lasts for a limited time after a policy is issued. An elimination period is imposed whenever a covered loss occurs. Insurers cannot deny coverage or charge a higher premium due to a pre-existing condition. Note the exception for plans with grandfather status. A guaranteed renewable policy guarantees that the insurer will not cancel the policy, although the insurer can increase premiums. A guaranteed renewable provision is standard in medical expense policies and long-term care policies. A non-cancelable provision is uncommon in medical expense policies. An insurer can cancel a policy or increase the premium on the policy's anniversary date, with sufficient notice to the insured. Please pause the audio and watch the video. You can restart the audio playback.
The mandatory and optional provisions discussed in other lessons, health insurance policies have other standard provisions and clauses that exist for practical purposes as well as statutory mandate. These common provisions define the policy's features, benefits, and limitations. Now, I want to talk about two common provisions in particular, and it's important to be able to differentiate between these two, and they are the probationary period and the elimination period, both of which are found in many different types of health insurance policies. Let's begin with the probationary period. The probationary period is a one-time period of time that must pass between the time a policy is issued and the time an illness-related loss will be covered. Think of it being on probation. If there's a 60-day probationary period, then during the first 60 days after the policy is issued, an illness-related loss simply won't be covered. Now, notice the emphasis is on an illness-related loss. To understand why that is, let's first understand that the reason for this provision is to protect the company against adverse selection, which is the tendency for those who need or think they need insurance to seek it out. To protect against that, the probationary period is put in there so that if somebody has a serious illness, it would probably become manifest during that probationary period and it would protect the company. Accidents cannot be anticipated. Accidents are not subject to adverse selection. And for that reason, the probationary period does not exclude coverage for accident-related losses. Or put differently, an accident-related loss is covered under a health insurance policy from the moment that the policy is issued. Once the probationary period is passed, it's never imposed again. It's a one-time deal. Now, compare that to the elimination period. The elimination period is sort of like a deductible. It's a period of time at the beginning of any loss that must be satisfied before benefits become payable. The elimination period, for all practical purposes, is only applicable with disability income policies. Those are, again, policies that would provide a benefit on an ongoing basis over a period of time. Again, I mentioned that it's like a deductible. Just as a deductible is intended to weed out or eliminate small claims, so the elimination period has that same purpose. Its fundamental purpose is to basically eliminate small claims that might arise when somebody's out of work for a week or two and only cover losses that extend for a period of time. Think of elimination period eliminates small claims. The elimination period can range from anywhere from a week or two to a month or two, depending on the policy. If the insured is disabled or suffering a loss at the end of the elimination period, then the policy typically goes back and actually covers the loss from the beginning. So it's not, unlike a true deductible that simply does not cover the initial cost, the elimination period does not exclude coverage on a loss if the loss extends beyond that elimination period.
Okay, so this is another long one. Let's get through these questions. The free look provision of a health insurance policies let policy owners return the policy for any reason within how many days? I'm going to guess 10. Which provision is a health insurance policy imposes a waiting period? Probationary period. During the probationary period of a health insurance policy, the policy usually covers losses from illness, maybe? All right, a health insurance policy with an optional renewal provision gives the insurer the right to cancel the policy at any time. All right, let's see how we did. I'm moving kind of quick because this is a long one. Okay, so I got the correct one for 10. This is 10 days. The second one is elimination period. Which provision imposes a waiting period? That would be the elimination period. You can review this video at any time and go back and look at this again and take these questions over. You can screenshot them, write them down, study them, whatever you want to study to get through your test. All right, during the probationary period of a health insurance policy, the policy usually covers losses from accidents. Okay, that was kind of tricky. I mean, what is considered accidents? Does it tell you? All right, a health insurance policy. Oh my gosh. A health insurance policy with an optional renewal provision gives the insurer the right to cancel the policy on a date specified in the contract. That's the correct answer there. Okay, so that's the end of this video. Thank you, everybody who stayed till the end.